most of the overhead. We retain the staff to run the online portion of those businesses, and we own the customer database, and anything that is considered intellectual properties has value. It's got a lot of brand equity. So we just run those businesses online, and we're continuing to grow and scale those businesses, and that's part of our portfolio.
You're listening to Ice Cream with Investors, a podcast that is dedicated to teaching you how to better invest your money so that you can live a more intentional life. I'm your host, Matt Four, and it is my goal to teach and empower you to remove the roadblocks to your financial success. All right, Marco, welcome to the show.
Hey, Matt, it's great to be on. How are you?
Absolutely. I am fantastic. We talked a little bit before the show, though. You've got a nice sunny background in California, and I'm staring at tornado clouds over here in Nashville today. So hopefully we could get this recorded, and I can go find a nice spot in a basement to hide from a tornado.
Wow, scary, man.
Yeah.
Well, look, you have tornadoes, we have earthquakes. So,
pick your poison.
Pick your poison. Right.
Well, we like to start with the difficult questions here. What is your favorite ice cream?
It would be chocolate chip cookie dough.
Okay. Now
you got a lot going on in there. You've got the ice cream, you've got the crunchy chocolate chips, and you've got the the delicious cookie dough. And who doesn't like cookie dough? So,
amen. Now you're joining us from Orange County, California. I was out there last year, and we stopped at an amazing ice cream joint, and I can't remember the name. But the next time I come out there, where's the place I need to go for ice cream?
Was it called Handles with an H?
Yeah. I think it was, actually.
Yeah, that's probably it. Yeah, it's handmade, handcrafted ice cream. It's a good ice cream place. Yeah,
love it. Well, tell our listeners, what's the scoop? What do you do today?
What do I do today? What don't I do today? So there's a lot I do. I'll kind of just narrow it down to three main things. One is, for 20 years, I have my nationwide turnkey real estate investment company called Norada. I think it's pretty well known. If you're in the real estate space, especially if you've been following anything related to turnkey real estate investing, I was the first nationwide provider out there 20 years ago that marketed the bejesus out of the word turnkey. And now everybody uses it and puts it on anything like lipstick on a pig. So, it's something we do day in and day out. We help hundreds and hundreds, if not thousands, of investors invest regardless of where they live, in markets all around the country where the numbers make sense and there's good inventory with truly turnkey investment property. So it's a free service, tons of value, and we're essentially your one-stop shop. So I spend some time on that. And tied with that is the Passive Real Estate Investing podcast. It's another real estate show like yours, where we talk about passive real estate investing, hence the reason for the name. The other thing I'm heavily involved in right now is our private equity firm. We raise capital through Norada Capital to grow, fund, and build business ventures that we have, mainly e-commerce and educational masterminds. And one of those educational masterminds happens to be deep dive into real estate. So there's definitely a heavy focus on real estate investing. So we have two masterminds that grew out of Norada Capital and the capital that we raised through promissory notes, which is a high yield. So anybody who's an accredited investor that wants a high yield can do it there. And then those are really the two main things. But something that kind of spun off of that was something I do more as for fun and as a passion project, but truly still an investment, is I co-produce a lot of Broadway musicals. So and a lot of people just don't know that, but I'm involved in about 12 or 13 Broadway musicals right now as a co-producer. And 4 of them just got nominated for a Tony Award. So hopefully, fingers crossed, I'll be receiving a Tony Award next month. So
do you get to go to the award ceremony as a co-producer?
You can, but yeah, you have to pay. It's not like you just it's a free thing. It's very expensive. An orchestra ticket is about $2,500 per ticket, and then the gala is $600 a head after that. So you're, for 2 people, you're into it for almost $6,000.
Yeah. Wow. How did you get into? I know this is a real estate show. We'll get to the real estate, but how did you get into the Broadway stuff?
So long story short, I'm a big believer in masterminds, and I think everybody should be a member of a mastermind of some sort, right? And I've been in masterminds for about 10 years, and sometimes multiple masterminds at the same time. So I was in one called War Room. It doesn't exist anymore. It was wrapped up last December, and the principals of that went off and did their own thing. But I was sitting next to a guy by the name of Ken, who's a lead producer on Broadway. And I didn't know that. I just met him for the first time, but he was a member of War Room as well. It was his first or second year. And we were sitting next to each other, and we got talking, and he was fascinated by what I did with the whole turnkey real estate stuff, because he said, man, where were you 5 years ago? Because everything you do is what I need and want. And you could have, certainly been helping me build my real estate portfolio 5 years ago, and I would have, saved all the brain damage. And then, I asked him what he did, and he said, well, I'm a producer on Broadway. And I go, oh, that's interesting. Cause I fell in love with live theater about 30 years ago when I first saw Phantom of the Opera. And so we got talking, and I started picking his brain as he was telling me more about what he was doing. And he told me about one of the projects coming up. And I said, oh, that's very interesting. I might be interested in doing something with you on that, like at least put my toe in the water and investing with him. But anyway, one thing led to another. I got to know him over time. Then we became friends. And then, all of a sudden I started investing in one production with him, and then another, and then another. And all of a sudden, the next thing I know, I'm involved in like 4 or 5 productions as not only an investor, but beyond that, like a co-producer. And, that just kind of grew and grew and grew. But that's how it all started. I met this guy named Ken, who was the executive director for North America for Andrew Lloyd Webber, the guy who wrote,
Wow.
Cats, Jesus Christ Superstar, Phantom of the Opera, and all that. He lives in London. He can't be in the US. So his right hand was Ken for about 5 years. And so, now I've got this great relationship and friendship with someone who's active on Broadway full time. And now I'm in those circles.
Yeah.
Co-producing, and actually I'm also a Tony voter, so I get to go to all the shows for free.
Amazing.
Yeah.
A question that kind of comes across my mind is, did you know anything? Had you produced a show? Had you been a part of plays before? Like, if you're going in, you're saying, hey, this is something I'm interested in, I would love to do something with you on this, and then become an investor. Like, how do you even start to underwrite something like that if you don't have any experience with it?
Man, I'll tell you, in the very beginning, it took me a while to wrap my head around that business model, because I knew real estate so well, and how to underwrite a real estate deal, and how to underwrite and evaluate a business. I had a hard time understanding how to underwrite a Broadway production, or even a film, like even a something that is film based. The investment model is different, and it took me a while to understand it. So I had to just with everything else I've done in life, I just jump in head first. Sometimes it's like ready, fire, aim.
Yeah.
And so I jump in, and I had to just basically immerse myself and consume myself in it to understand, read as all I could, books if they're available, research online, asking lots of questions, because the model is so different. It's like, oh, you invest and you get a rate of return, like there's monthly cash flow and stuff like that. No, it doesn't work that way. When you're investing in a production, the first milestone is recoupment. Like your goal, and it doesn't always happen, your goal is to recoup your original investment, the principal. And depending on what stats you look at, you'll probably only recoup on 3 out of 10 shows. Sometimes the numbers are worse, but Broadway's very, very expensive. It's cheaper in London. Now we're starting to do shows in London. But the recoupment is your first goal. Once you've recouped your original investment, now you got your principal back. Now anything that happens thereafter is profit. So now you can start to calculate your return on investment as each month and every quarter and every year goes by. Sometimes they're, home runs, like you'll have a Hamilton or a Moulin Rouge. Sometimes, you just recoup your principal and maybe make some money, like 2 out of 10 times. But about 6 or 7 out of times, you'll probably lose money. You won't recoup your original investment. So it's a different investment.
Almost like a venture investment at that point. Like, yes. You've got an idea, it's seed capital. You don't know if it's really going to pan out. Let me put some money in here. And, hopefully the one that takes off and is a Hamilton type production pays for all the other stuff.
Exactly.
Interesting. All right. I want to shift us back to real estate real quick. So turnkey investments. I remember hearing you in my ears back in like 2012 to 14 talking about turnkey investments, and it does seem like you were everywhere with this idea of turnkey. If that is a new term for a listener out there, can you help us define what is turnkey? And then I want to talk a little bit about how you see in that market today.
Well, our definition of what it is not necessarily the same as what other people have. People have kind of borrowed and plagiarized that term. But for us, a turnkey property is a property that is in a good market, and we can define that, but a good market in a good or great neighborhood. The property itself is either new or like new, meaning it's either new construction or newly renovated. Those are three key factors. Obviously, you want professional, full-service property management tied in with that. If you're not going to self-manage, and you can self-manage remotely, a lot of people do, but most people who want to be as passive as possible don't get involved in self-management. But there's nothing wrong with it. You can, and you can do it fairly easily. So if you got the market, the neighborhood, and the property all buttoned down, you're 90% of the way there. Then you have to have the right team around you, and part of your team is your professional full service property management company. So if you have all that with the right team, and you have the right guidance, you've got a turnkey real estate investment, and you've got the turnkey experience to go along with it. And that's what we try and provide. So those are the check boxes for the most part, right? Obviously, you want the property to carry itself, which means that it has a positive cash flow, because you want the property to pay for itself, ideally with something left over, which is your spendable cash, which I don't suggest you spend. I suggest you bank it and reinvest it. But that's our definition.
So when are you doing any new development, or are you just rehabbing most of your homes today?
That's an interesting question, because up until about 2018, 19, it was almost all newly refurbished property, meaning it's resale inventory. But then as inventory continued to get tighter and tighter, which is a problem today, a good problem depending on what side of the equation you're on. But as inventory continued to get tighter and tighter, there was this movement towards more and more new construction homes, because if you wanted the inventory to invest in, you had to just go the new construction route. And so we started establishing relationships with new home builders, mostly in the Southeast, but all over the place, to provide us inventory that was new construction, because that was the only way to provide our clients, the investors that we work with, product to invest in. And at the same time, there was this massive movement towards B2R, built to rent home product. And so a lot of builders caught on to the fact that there's a lot of opportunity out there for real estate investors to be buying the product, not selling to homeowners, but to actually investors who will now turn around and rent the product out, just like what Invitation Homes was doing. And, all the other iBuyers out there, that were buying a bunch of product, Blackstone. There was this need and hunger for new construction rental homes. And so this whole movement in B2R, built to rent, came about. Now, a lot of builders build a lot of product that are meant specifically for tenants. They're designed with tenants in mind, but sold to real estate investors.
Yeah, it's almost like affordability for homes has gotten so far out of reach that if you are young and you get married and you want to have that white picket fence and 2.5 kids, what's your next option, or how do you start working your way towards that? You move into a home that's already built for rental, so you have a little bit more space, but it is a home.
Yeah, that's exactly it.
You mentioned saying you got to have a good market. I'm interested, for a guy that kind of goes nationwide with a lot of different investment types. How do you define a good market? What are you looking for?
There's about three things you want to look for. One is you want a market that has a stable job market, ideally job growth. That's not critical, but as long as you don't want to see a declining market year over year in terms of job growth. Second, which is tied at the hip with the first one, you want to see population growth. Again, you don't want to see a market that is losing population year after year in a downward trend, because ultimately that's going to put downward pressure on the housing market, lower prices and lower rents. So you want stability in both of those categories, but if you actually have job growth and population growth, you have a perfect environment to push prices up. Like you will see continued price growth and rent growth. So those are the two main things when it comes to the market. The third thing you want to see, the third and fourth thing you want to see is one is available inventory. If you can't find product in a market that has job growth and population growth, you're not going to get very far. It's going to be a struggle to get inventory. It's going to be brain damage to try and find a good deal. And then fourthly, the numbers have to make sense. So you can't be investing in a San Francisco, a San Jose, a Washington, D.C., or places like that, because not only are property prices so high that it doesn't really make a lot of financial sense, but it really doesn't make sense when you compare the purchase price of those properties to the median rent. When you look at median price and median rent, they're so out of whack that it's what we call the rent to price ratio. If that ratio is like 0.4% or 0.5%, even 0.6%, those numbers don't really work to give you a good cap rate and therefore an attractive cash on cash return, even with leverage, even if you fully leverage it. But the problem with that is if you fully leverage it, you're going to have negative cash flow because your debt service is so high for such an expensive property that you're losing money every month. You're having to pay the difference, right? So you need those four factors in a market.
Yeah, there's a big underlying movement right now in conversation happening around first-time investors on a deal doesn't have to cash flow. Just buy it today because pricing will go up and rates will come down, all those sorts of things. I would love to hear your take on that. Like, I'm a firm, adamant disbeliever in that statement. I will not buy something that doesn't cash flow because at that point I'm just speculating. And if I'm going to speculate, I should speculate in something more liquid. That way, if my decision doesn't work out, I can get out of it quicker. But what are your thoughts on this overall conversation that's around cash flow and appreciation right now?
Yeah, I tend to agree with what you just said. If you're going, first of all, one of my rules is don't speculate, never speculate in real estate. So that's just gambling. If you're going to, the only exception I have, like I want positive cash flow, but if I'm going to have negative cash flow, I want to know that it's short term, meaning that for whatever reason, I've got a discounted rental rate that I can increase in a year or two, will change, or that I've got basically zero cash flow, and I know that the rental market is so strong that the odds of me increasing the rent over the next year or two is going to go up. So I can take care of that. If I lock into a mortgage with a fixed rate, 15 or 30 years, I know my costs more or less are fixed. Like, they're not going to change all that much. Property taxes might go up. Insurance might go up a little bit. But if I can increase my rents more than my expenses over the next 1, 2, 3 years, then I can get into a positive cash flow scenario. But I don't want to lock in to a scenario where I have negative cash flow for an unforeseeable timeline or future. So, because that's not sustainable. If I'm in a very, very strong growth market where I see strong appreciation and the likelihood of appreciation is going to continue, like the probabilities are high, that's great. That's all well and fine. But now I'm making an assumption that I'm going to flip the property or do a 1031 exchange with that property to take that equity elsewhere where I do have cash flow. So if you've got a solid plan in place, then it can make sense. That's really more of an exception, not the rule. That's not a typical game plan. And you could probably survive it if you only have 1 or 2 properties, under that scenario. But if you're going to be stacking and you've got like 5, 10 properties like that, man, you better hope it works out, or you have really, really deep pockets, because you're not going to be able to sustain that for a long period of time.
Right. Right. Another piece you mentioned about a good market is this idea of population growth and inventory. And I just want to talk about this for a second. I think one of the things that happened in 2021 is a lot of people were going where people were moving, but there wasn't underlying job growth. So I poo-poo on Boise, Idaho a lot, is a sense of like you had a lot of Seattle people, a lot of California people kind of move out during the COVID time period. And now Apple wants them to come back into work. Amazon wants them to come back into work. There wasn't job growth. There was some sort of other population growth. But also there's this idea of inventory. And this is one of the things that I think I've learned the most over the past 2 years is that understanding what an inventory level looks like for a population is extremely important, because at the end of the day, real estate is supply and demand. How many people want homes? How many homes are available? And if you have an imbalance there with more people wanting than inventory is available, that's usually a good position to be in as a real estate owner. It's a bad position to be in as a home buyer. So if I'm a new investor and I'm looking at markets, how do I understand, or where do I go to find these inventory metrics? And maybe you could give us some insights on what you look for from an inventory standpoint.
It's a little difficult to find that information on a local market level. The data is out there. Usually you have to pay for it because it's going to be with some big aggregator or provider, whether it be CoreLogic or whoever it is. There probably is some paid services out there that can provide some of that information. It's not widely available. And as a side note, I've been thinking about creating an online subscription tool where you can tap into that data, where, I license the data and put it into a presentable format, where investors can analyze different markets or zip codes, whatever it is, and just see what's going on. I would have done it by now if I had the time, because I would want a tool like that for myself. And I probably will do that, maybe later this year, but I don't have it done yet. In fact, I've already bought the domain name for it from someone else who charged me an arm and a leg for it. So I would like to put that information out, but thinking about it, at the national level, how do I put this? Right now we have a huge undersupply in the country. Okay. Currently, as it stands right now, we have a deficit of about 2.1 million housing units as we talk today. In order to get caught up, we need to be producing 1.86 million housing units a year, in order to get to the point where we're going to catch up. We need 1.65 million units right now just to continue with the growth that we have going on at the moment. Right now, we're producing less than 1.4 million units a year. Some stats recently have even said that we're producing 1.2 million units a year, which further exacerbates the problem. But there's a lot of housing demand. We need 1.86 million homes. Now I'm talking about sale and for rent, like throughout the year, per year, until for the next 10 years, until 2033, actually. So that's actually 9 years, but you get the point. So this is a problem for the country. It's a housing market problem. But if you're a real estate investor and you can get into the market, it's a good problem to have, because that strong demand, being 2.1 million units underbuilt right now in 2024, means that you are on the right side of the equation as an investor. It means that property values will continue to go up because of demand and lack of supply. Rents will continue to go up. You're in a great spot to be in. And real estate is a very, very, very slow moving asset class. For that to correct itself is going to take time, a long time. It's not going to happen overnight. So the key is this: knowing that on a national scope, the national landscape, pick the markets where you see migration going towards, population growth. A lot of the markets in Florida, a lot of the Sun Belt, the southern third of the U.S. is hot, like figuratively and literally, because people are moving there. There's a lot of pressure and demand because of the demand. So if you focus on those markets where there's inventory, where the numbers make sense, right? The things we talked about before, where there are jobs, you have the deck stacked in your favor. Like, it's hard to lose. Even if you make a small mistake in the beginning, real estate is very forgiving. Like, in the next, 2, 3, 4, 5 years, you're gonna come out ahead smelling like a rose. So you've got to focus on those factors.
Yeah, I think this housing supply shortage is something that's not going to get fixed overnight. And even if we decided at every local level that we wanted to fix the problem tomorrow, it's still a 5 to 10 year problem to go solve if everybody got on board. So I do agree with your sentiments that if you can find a way to get in the market at a cash flow basis in a market that's going to grow, you're going to find yourself on the right side of that equation.
Mm-hmm. For sure.
One of the things I love about you and your show and everything I've learned about you in our time together is that you really focus on this idea of passive investing. Real estate has been a main vehicle for you, but it's not your only vehicle. Earlier in the show, you mentioned something about promissory notes and what you all are doing in that space. So I want to dig in there a little bit. To start, in case it's a new term for any investor or listener out there, what is a promissory note? Hey, fellow investors. Before we dive into our next segment of the show, I wanted to take a quick moment to talk to you about a fantastic opportunity for you to invest with me. As you know, here at Ice Cream with Investors, I'm passionate about real estate investing and helping you navigate the exciting world of wealth creation through real estate. And that's why, for the first time, I'm thrilled to tell you about an opportunity for you to invest alongside of me. Over the past 3 years, I've been investing in multifamily, mobile home parks, car washes. I've even become the bank and lent out money to fellow real estate investors on a short-term basis. And now you can come join me. If you would like to jump on a call and learn more about this opportunity, head to icecreamwithinvestors.com/invest and find a time for us to connect. And now back to the show.
A promissory note is nothing more than a loan agreement. It's just another name for a loan agreement. It's just a simple document between two parties, a borrower and a lender. And it just lays out the terms, the start date, the end date, the interest rate, how that's being paid. Is it monthly, quarterly? Is it a balloon payment at the end? And, that's pretty much it. That's all it is. So if you've ever signed, a student loan, a car loan, a loan for anything, a signature loan, an SBA loan, any of these loans are written as a promissory note. It says note on the top or promissory note. Occasionally it'll say loan agreement, but a loan agreement is by definition a promissory note. So that's all it is. It's just a loan agreement.
Gotcha. So what are you doing in the space for promissory notes?
Well, it's a little bit off topic as far as, talking real estate, which, is what your show's about. But our sister company, there's Norada Real Estate Investments, which is, the turnkey real estate side. The sister company is Norada Capital, and Norada Capital Management is a private equity firm. Investors invest in it, we're using a promissory note to earn 12% a year or 15% a year. It's a fixed rate of return. It's paid monthly, like a monthly interest payment, direct deposit right into your bank account. So it's very, very passive because once you set it up at the beginning, it's just automatically scheduled through bill.com to go right into your account every month. And so you can choose a term of whatever, 3 years, 4 years, 5 years, and you just get, monthly predictable income that comes in. The promissory note's the instrument, the vehicle, but the instrument we use to make that investment. And I don't know if I just answered your question or not. Was there another part to it?
Well, what's the underlying asset that you all are investing in to? So I'm an investor. I'm lending you capital from a 12 to 15% return perspective. I get paid monthly, but what are you doing with that capital right now?
Yeah, good question. So this is kind of what we were talking about a little bit before. Norada Capital invests in three main categories, two making up about 90% of our assets under management, basically our portfolio of assets. The first being e-commerce-based businesses, which we are growing and scaling, and many of them are name brand businesses. And, I can mention those. We talked about it before. The second category is what I refer to as educational masterminds, which is a very lucrative, profitable, rapidly growing part of our company. Is our two main masterminds, Money Is and Level Up. Level Up is all about real estate. So those are the two main categories. The third is a very small percentage of it, and it's what we were talking about before, which is the Broadway productions. The theatrical productions are that small sliver of that pie. But the e-com businesses, some of them are recognizable by most people. Dress Barn is one acquisition we made. Pier 1 Imports was another acquisition. Linens and Things was another acquisition. And when I say acquisition, we didn't acquire the brick and mortar stores. We let that company go through a Chapter 7 bankruptcy. They liquidated the stores, a lot of the inventory and the assets, and then we took over all the intellectual property and continued to run it online as an operating business with daily sales entirely online. So we eliminated a lot. We eliminated the debt. We eliminated most of the overhead. We retained the staff to run the online portion of those businesses, and we own the customer database, and anything that is considered intellectual properties has value. It's got a lot of brand equity. So we just run those businesses online, and we're continuing to grow and scale those businesses, and that's part of our portfolio.
Did you actually acquire? So Pier One is a name that I think most of us 90s babies would know. Did you acquire Pier One then as an example in this?
Is exactly what we did. So, to give you the detail of how that came about, because it is an acquisition. When they filed for Chapter 7 bankruptcy, we went to them and gave them an offer. We said, we'll buy all your intellectual property for X millions of dollars. And we did that first with Dress Barn and then Pier One. And they basically said, they reviewed it at the executive level, and then they took it to the board and everybody bought off on it. So everybody signed off. And then we became the stalking horse bidder. So when the auction came, as part of that formal federal Chapter 7 bankruptcy proceeding, we won those auctions. So we took possession of their brand name, the trademarks, the brand equity that's tied in with that, their customer databases, their website, the domain names, and that's all the stuff of value, because we could take that stuff and now run that business online, market to that customer database and all their subscribers, continue to generate sales, and do some more marketing to drive new traffic in from Google and social media and Facebook and wherever else. So now we have complete control over those businesses, and they're debt free. So the sky's the limit at this point. We'll just turn it back into another $1 billion business.
Is the goal to only focus on those 10 brands, or are you continuing to look across this landscape and say, hey, these are legacy names that have IP value to them, that are struggling in the brick and mortar space that we can go run this online sales play with?
The only thing we'd be interested in are major brand names that come up for, that file for bankruptcy. We actually tried others. Like we didn't acquire all of the ones we went after. We went after Toys R Us, Forever 21. I forgot some of the others. There were others. We tried to go after them. They were either way too expensive or we got outbid, Yeah. So the opportunity is still there. It just comes and goes, but we're not actively looking for another acquisition at the moment. Right now, our focus is to build, grow, and scale the ones we have, to take them to another level, like 10x the revenue, 10x the valuation, and get it to a point where it's worth 9 figures and ultimately, 10 figures.
Yeah, I mean, at the end of the day, you're just you're a private equity firm, right? You're buying a distressed asset and you're rehabbing it, and then you'll go sell it off to somebody else that wants to take it to that next level, whatever that may be.
Yeah, you can think of it in real estate terms. You buy a distressed asset, you take it over, you manage it properly. If you fix up what needs to be fixed up, you increase its valuation, you increase its cash flow. Now you have more profit, more equity, more cash flow, and it's you've just built something bigger and better. And unfortunately, with real estate, you have a cap. You can't raise the rent more than market rent, or maybe a little bit more than that. But the nice thing about having a business is it is far more scalable. Your limitations now no longer how much profit can I make. It's really how big is the market that I can profit from.
Yeah, and you all have revamped those businesses too, where if you are a Pier One in Omaha, Nebraska, you're probably never selling to anybody in North Dakota. Whereas with an online presence, you're just one Google ad away, one click away from being able to acquire that customer.
Correct. That's exactly right.
Yeah. Amazing. Well, Marco, I could sit here and talk for hours about this topic, but I want to be cognizant of your time and switch us now to our last round. We're calling this the 4 toppings. Our first one is, what is your favorite book, or what is a book you've read recently that's given you a paradigm shift?
Well, when you said paradigm shift, it changed my answer because I think the biggest paradigm shift I had, it's funny because I was already an investor and already an entrepreneur. But I think it was in 2007, if I'm not mistaken. I was on vacation in Italy on the train going from Rome to Florence, and I started reading this book called Rich Dad Poor Dad. And it's like,
never heard of it.
Yeah, it's like I couldn't put the damn thing down. Like I'm this nerd or geek on the train, with my head stuck in the book, and everybody else is looking out the window at the beautiful countryside going by. And here I am, like I just couldn't ungrip this book. To me, even though like I wasn't dumb or anything, I was already doing it. I was already doing deals. It's just it was a paradigm shift. Just reclassifying how you see assets and liabilities and all that stuff. Robert Kiyosaki did a very good job in that book, as far as explaining things in layman's terms that anybody can understand.
That's it right there. And I would agree with you. I haven't that and 4 Hour Work Week after reading those two books when I was first starting my journey. I've never been able to look at the world the same anymore.
Yeah, exactly. So true.
Our second one is, what is the best piece of advice you've ever received?
Well, as I think about that question, there's probably dozens and dozens. If I have time to think about it, I could come up with many. But the one that came to mind first is, I almost want to say, the art of delegation. It's really an art and science, but I didn't realize how much further I can get ahead by delegating. I always wanted to do everything myself, like I could do it better, I could do it faster. And that's true in some cases. But when you find the right person to delegate your tasks to, you free your time to do other more productive or more important things. You can now apply your time to its highest and best use. So delegating is something that I don't think enough people talk about, but it's very powerful. It could be in your personal life or in your business life. It could be at home. It could be at work. Just knowing what to delegate and doing it. And I still struggle with that today. I mean, I want to almost say that I suck at delegation, but I'm working on it to try and get better at it.
Based off of everything you do, I would beg to say you don't suck at it, but I think it's all something we can all get better at, and I suffer from that too. And one of the things that I'm learning as I start to delegate more too is how much mental capacity you free up with little things like just doing your email. Responding to emails takes 30 minutes. You probably don't think it takes too much time, but if you're going to go create something, it takes a lot of that mental capacity down.
Mm-hmm. Yeah.
Our third thing is, what are you most proud of in your life?
My daughter.
How old is she?
She's turning 17 already next month. So in about a month. Yeah. And believe me, those years go by fast, especially the teenage years, like the second half. Those go by, for whatever reason, they just seem to go by a lot faster than the first, half. But yeah, just having children is great, and having kids is great. And, just raising them and spending time with them is great. And doing a good job at it is great. And so, I'm happy about it. I'm proud about it. I mean, I wish I had more kids, but yeah, that's my answer.
You said something there. One of my friends that I caught up with in first time in like a decade, he's having his sixth kid, and I'm like, holy smokes, 6. And he goes, yep, I've never met anybody that gets at the end of their life and says they wish they had less kids. And I was like, well, it's an interesting proposition. And you just said it too. So
is that true? I've never heard that said before. I wish I had less kids.
Yeah, I've never heard that said, and my parents live in a retirement community where there's a lot of strain between parent and child relationship. I have a great relationship with my parents, so I can understand that, but there's a lot of strain, so maybe it's not completely true, but he seems to be going down that path.
Yeah, I like it. It's good.
Our fourth and final one is, if you could sit down and eat a bowl of ice cream with anyone, dead or alive, who would it be and why?
Oh, wow. Wasn't prepared for that one. A bowl of ice cream with anybody?
Dead or alive?
Does it have to be business related?
Nope. Anybody you want.
I'd say my dad.
Yeah?
My dad passed away like 6-7 years ago. And, you don't think about the things you wish you would have done until after the fact. So
we should have that conversation afterwards, because my parents are starting to age, and there's a lot of things now that one of them is I would love to have them as a guest on the show and record that, because I know one day that will be something special to me. So I would love to hear your answers to kind of those questions. But
very cool.
Marco, fantastic conversation. Always love getting a chance to hang out with you. If our listeners wanted to reach out to you, learn more about what you've got going on, where is the best place we could point them?
I was always giving out the noradarealestate.com and noradacapital.com websites. And my business partner actually told me, said, you know what, you got so much going on. Why don't you just point people to your personal website that links to everything? So now I just give out my personal website and my Instagram. So marcosantarelli.com. So my name.com is my personal website. It links to everything I do. And then on Instagram, Marco G. Santarelli on Instagram, and I post every day.
The real G himself. We will link those in the show notes. And then Marco, thanks for coming on the show.
Thanks, Matt. This has been great.
Thank you for listening to Ice Cream with Investors. If you like what we serve you here, it would mean the world to me if you would like, subscribe, and leave a review on your favorite podcast app.